So the title of this panel is Professional Service Providers for Digital Assets, Ensuring Security and Compliance. And I'm going to have the panelists briefly introduce themselves, and then we'll get into some questions. So Joe, you'll start.
I won't recap it again because you all just saw me, but Joe Medioli, Growth and Strategy Lead at Anchorage Digital, which includes Anchorage Digital Bank NA, as I mentioned earlier.
Hey everyone, Ervin. I run the institutional sales business for Securitize, and I'm the CEO of Securitize for Advisors, which was formerly OnRamp Invest. It's a technology platform for wealth management to get access to the digital asset ecosystem and to manage those portfolios, bill on those portfolios, and really kind of like create the same unique flow that they're used to through custodians of Schwab and TD Ameritrade and the like. So OnRamp really offers that Securitize solution, or that tech-enabled solution for wealth management.
I obviously got the memo to dress for the occasion. My name is John Wingate. I'm the founder and CEO of a company called Bank Social. So we provide open banking software built on DLT rails. And we do that for community banks and cooperative financial institutions around the world. We've already implemented into kind of the apps you open up on your phones, digital banking apps. We've already implemented self-custody wallets, payment rails, identity management solutions, all within banking apps as these cooperative, the DAO model, as these cooperative banks and these community financial institutions start to embrace, they're already DAOs, I call them analog DAOs, but as they start to, or I call them actually analog DeFi. Have you guys heard that phrase thrown around? As they start to embrace these technologies, we see them being the front line to consumer, retail, small business, and even starting to get into kind of more institutional grade self-custody through integrations with their members in digital banking and core applications.
Okay, thank you for the introductions, and let's start with the panel. So Joe, I'm going to ask you the first question. Please explain how Anchorage Digital provides a safe and secure way for institutional clients to access the digital asset ecosystem, and be as specific as possible.
All right. Well, I touched on a few minutes ago, how we're sort of approaching the wealth space, but I want to get into a little bit more detail. I mentioned that, Anchorage is a security company first. That's how we were founded. And that is, in this space of digital assets, especially from a custodial space, maybe the most important foundational element. And when we talk about security in crypto, right, I'm sure everybody's familiar with the concept of hot and cold storage. One of the maybe most important things to know about us as a company is that was a premise our founders rejected from the beginning back in 2017 when they founded the company. Right? There's this concept of, cold storage is safe but slow. Hot wallets are less safe but fast. The model that we took more or less splits the difference. And one of the reasons why we've really grown in this space and why we've become a starting point for many of the institutional participants is because we're able to segregate assets, secure those assets on chain, so no commingling at an institutional level, and yet still achieve transaction latency in a matter of minutes when we do it manually, and seconds to single-digit minutes if you do it via API. Everything is held completely air-gapped, not to get too technical, but in air-gapped hardware security modules. And we use our sort of unique biometric authentication infrastructure in place of any sort of passwords or user IDs. So we've taken a fundamentally different approach than what you're used to in a normal banking solution, either institutional or otherwise. And that foundation was really why we were able to attract institutional participants at first. Right? We have a way to secure billions of dollars where our clients, again, we're a self-directed trust at the banking level, our clients set their own policies. I want my treasury management team only to be able to access these assets, but I want my head of treasury, it has to be on every approval. They can customize those quorums, and they can transact as many times as they want in a matter of minutes. Right? That is fundamentally different than what has been available to date in the crypto space. Early on, we were talking 4, 12, 24 hours to get assets out of cold storage. So when we talk about safety, that is really where we start. The second piece of this is, of course, the regulatory perimeter. I talked about what we are doing in the US around the federal bank charter. This is the approach that we've taken internationally as well. We are working in Singapore. We're already grandfathered into Singapore's custodial regime, and we have an in-principle authorization for full scope services from custody all the way through trading. We have other pending licenses that I can't share right now. But our approach to this ecosystem is our clients need to feel safe, right? And not just feel safe, but be safe. So that means putting in the effort to do compliance, to do anti-money laundering lookbacks, to make sure that the provenance of assets coming into our platform is something that we're able to provide as a service, so that if you're getting deposits into your fund and they come from a sanctioned wallet, your fund doesn't become sanctioned, right? We are the ones that are becoming that sort of layer of protection. We take all of those things together, the security and the regulation, and then we pull those different pieces together to create different use cases, whether it's to service as a sub-custodian for banks, as a qualified custodian for wealth managers and 40 Act funds, or for fintechs.
Thank you, Joe. Okay, Eric, next question is for you. How does Securitize ensure that users' digital assets are safe and secure, and what role does an on-ramp play?
Sure. So I'll split this into two pieces. One is what is Securitize as a business? Securitize purchased my company, which was OnRamp at the time. OnRamp was the technology layer that plugged into Anchorage so that a financial advisor could work with their clients' assets with a qualified custodian and not have to worry about whether or not they were going to lose the client's private keys or they were going to touch the client's money in any shape or way, but also could trade a portfolio, could do all of the things that they would do for a brokerage account of a client, but with a bearer instrument that was held at a custodian that was legal and approved. So with Securitize, on the other hand, Securitize is a company that takes mutual funds, 40 Act funds, private funds, Hamilton Lanes, KKR, like all of these kind of private equity firms and others, BlackRock's big money market fund, and takes those and tokenizes them so that anyone can enable a blockchain-enabled solution. So I can now buy the BlackRock money market fund with my Bitcoin, for example, and I can trade in those different fund assets. So it's taking the traditional world of mutual funds and investment managers and bringing them on chain, whereas OnRamp, which was the business that I ran, was taking kind of the crypto assets and bringing them to the traditional world of financial advisors. So it's really like crossing those two bridges together. And I think as what we found is like as time continues to go on, more and more financial advisors and wealth managers are going to be working with crypto assets, and more crypto firms are going to be working with traditional assets. And eventually those two worlds, they'll just melt together. It's not like we're waiting for the crypto firms to become traditional, or we're waiting for the traditional. It's just going to all happen at the same time in the same place, I think.
Yeah, thanks. We're passing the mic here, but okay, John, next question. Bank Social works with credit unions to leverage blockchain and digital assets. I think that's super interesting. I wrote about it. What are the regulatory considerations here, and how are assets kept safe and secure?
So my story, a couple interesting things have been said tonight. My story with blockchain goes back to early 2010. You can come ask me about it. It's pretty interesting. But I've been a part of Mt. Gox. I've been a part of, I don't even want to go into it because I'm going to start crying. But I've been a part of a lot of the failures of custodians throughout time. And the one thing that I keep coming back to for me is that this technology was invented for this new proliferation of the web to occur, kind of a decentralized web, an ownership economy to proliferate. And so a couple years back, we were able to get the first guidance in the United States by a US regulator passed, the first positive. All the other regulators kind of took the approach of, come ask us and we'll tell you no, or try to kind of work between the lines and figure out a way to do something that's quasi. We were able to work with the NCUA, which is the regulator and the insurer for cooperative finance in the United States, to issue the first and only positive go forth and conquer guidance for those financial institutions. And it's opened so many doors. You know, I would suggest if you're in a space to go read it, you can just search NCUA DLT guidance, and you can see we actually worked with them to write that. So when we got that passed, the credit union space, kind of I call it the analog DeFi, they were very quick to embrace this technology, the self-custody concept, where we could take our digital wallet, we can embed it into their digital banking in a self-custody way. We have some really novel tools that we've built with some really great people. That decentralized recovery is one of the tools that we have. So instead of putting your keys in a single custodian or in an MPC, multi-party compute type of scenario, we have a distribution into the credit union network. And so, you know, the whole goal here is we believe that finance is social, finance is between people. The ownership economy was meant to put ownership. If you look at what the CFPB is doing, if you look at a lot of the regulatory agencies that are focused on how to provide kind of this platform and this openness of banking, which is really what we're focused on, the CFPB has come out, Rohit Chopra, he's actually used two words that I love, open and decentralized. He's actually used those two words. And so the CFPB, you know, we talk to a lot of the 3 and 4 letter acronym agencies. They know, they understand this is coming. When you look at a lot of the SEC enforcement action, when you look at a lot of the Wells notices, they are focused on, you know, and I'm not going to say across the board, there certainly have been, you know, kind of DeFi and self-custody intermixed in there. But the vast majority of it is where you go off chain, where funds are flowing into people's pockets, or funds are kind of moving, you know, in a way they shouldn't. And so we do see kind of this open, decentralized, self-custody ownership economy proliferating. The CFPB is going to start mandating it. Our credit unions, our cooperative financial partners in the US, Australia, India now. You know, we just made moves into countries like Sri Lanka, Nigeria. They understand that this is the way they want to go. This is what, you know, kind of puts the human at the forefront of owning their finances. It kind of takes governments, not the control away, but certainly the bad actors, the confiscators. You know, there's still a few kinks to work out in the ecosystem. I think we would all agree. But we feel like the movement in this area, especially in the United States, towards the open ownership economy is where things are headed quickly.
Thanks, John. And I think it's important that you mentioned you work with the regulators. I think that's really important to keep in mind here, is that people in this industry, all 3 of you, should be working with the regulators to educate them and to help push compliance, because that's the only way the industry is going to grow and mature. So John, that's really cool that you did that. Let's talk about how the regulatory space in the United States is going to take shape moving forward. I want each of you to answer what you hope to see and why. So Joe, we'll start with you.
Ooh, that's a big question. You know, in the U.S., you know, I think we have a very interesting challenge, and it's something that you know, John just mentioned, right? We have multiple regulators at the state and federal level that are all at different stages of maturity, right? And it's created, you know, in some cases really weird arbitrage. It's created really weird moats. You know, at a macro level, I would like to see true federal regulation around how this ecosystem can operate, where the rules are not different depending on, you know, what state you decide to work in, or frankly even what type of a company you want to engage with. And that's going to come with a lot of action. I think at the near term, for me personally, one of the biggest things that can happen is honestly at the SEC level. I don't want to talk about regime change or anything like that. There are things on the table now that have been pending for over a year that can help move things forward. The pending safeguarding rule, getting that over the line so that this entire asset class and the people that are investing in it can have some clarity as to what's coming around the corner. Because the investment in these assets and the sort of the growth in the AUM that we're going to see out of that is going to send a message at the federal level that more needs to be done because everybody wants this in some fashion or not.
Yeah, just for everyone's sake, it's a real challenge having multiple regulators all fighting for turf. In my previous life, I built an ETF company, and we launched a product that was the CFTC and the SEC couldn't decide who should regulate it, and so I spent 2 years of hell of my life trying to like navigate that thread through the needle. And it's exactly the same that we have here. Is the CFTC says it's a commodity, the SEC says no, it's a security. The industry says just pick, for God's sakes, but please like give us some guidance. And I think like Hester Pierce is, she's been very outspoken, but she proposed some pretty reasonable regulation of just a safe harbor. Like you launch a protocol, you raise capital. For a while, it's a security, but then eventually it starts to become decentralized enough and in enough hands to where it's no longer a security, it's a true commodity. I don't think anything like that is going to get passed, but if I had my wish list, that would certainly be one of them, to where we actually knew where we were in some of these things. And then when it comes to like advisors getting access, I kind of think of it as almost like flower fields without fences. Because right now I have to go to my brokerage account to buy my brokerage or to my stocks and that portfolio. I go over here and I buy my crypto at Coinbase or Anchorage or these other places. I can't do all of this in the same place, and that's just insane. Like why is it like that? It's just because we have multiple regulators and they can't decide who should regulate. So
a couple things. First off, I never try to hope for things to happen. I actually do what we can to go out there and do it. So next month, for example, I'm speaking with NASCUS. We try to quarterly get in front of all 50 regulators, all 50 state regulators. We educate, we talk through. Again, we're not focused so much on the custodial side. So there is a big difference in putting kind of self-custody in somebody's hands. The regulation that goes with that, there's just a vast array of differences. When our regulator came in the first time and took a look at everything, when they found out we were doing self-custody, it was like a 5-minute deal. They were like, "Oh, okay, easy." We've talked to a few other companies that were doing custodial services, and you've got to have pages and pages and books of breakdowns and understanding. So. From the regulator's standpoint, we also don't think that there's a need, again, kind of difference of approach from custody to self-custody. We believe that most of the laws that we need are actually in place. We certainly think there are room for new laws, room for new, more so guidance than laws. So the thing that most people don't understand is, guidance is the regulator interpreting the law. And a law is a law that will never come off the books. And we should, at all costs, and I think we would all agree, that we would prefer guidance over lawmaking. And so we don't believe that any new laws are really needed. And if there are, it's probably more at the state level, in MTL, in state securities. We would like to, I actually don't think Howie being 4 sentences is bad, because for just as much opportunity as they have to argue a position, you do as well. So, we really think most of the focus is on guidance. That's why we focus heavily on the regulator space and helping formulate, declarative guidance that informs the end users, informs the institutions, informs the custodian, informs all the players in the space without having to worry about, this new book of laws that gets put in place that will never be taken off. So those are the approaches we've been taking quite successfully.
Wonderful. And I can say, I've been in the space since 2017, and it has taken shape. It's matured a lot. So everybody, has really done their part in helping the industry grow, you guys. So thank you. We have a few minutes left. If each of you want to just take 1 minute to say some final thoughts, and then we'll go on to the next panel.
I think as a final thought here, maybe taking a step back to this long-term vision, right? I think when we really zoom out to the potential of this ecosystem, I think one of the points John made is right? There's a world, just like in traditional financial services, where you can have your own assets, right? Or you can use institutional providers, and they come with pros and cons. I actually agree with the concept that the right laws are already on the books, right? Interpretation, guidance is really important because that's also what creates a level of clarity, at least, for regulators interacting with their partners. I think, though, when I try to look like 5, 10, 15 years out, whatever this is, my North Star in the space of crypto is a very banal thing. It's the next time I buy a mortgage, I don't want to pay a lawyer to do a lien search, like, whatever it is, $4,000. Because at that point in time, I would expect all of the history, all of that information in that database that a lawyer is looking through the Norfolk County, registry of deeds to make sure that I don't, owe something on the house, is on a blockchain, right? How we get there is going to be a combination of everything that we've talked about here, right? Proving that there are institutional providers who can be safe and secure and act in good faith, working with regulators to establish the right standards. Like, that's a world that we can get to. When we can start taking intermediaries out of this ecosystem to the benefit of everybody, investors and consumers down the stack, that to me is the North Star in all of this.
Yeah, I guess I'll just answer this almost like from an investment point of view, because I think a lot of us that's why we're here. I've been in the wealth management business for my whole life. I've never seen an asset class with as much alpha as the digital asset ecosystem, and alpha is kind of outperformance. And when I was at Morgan Stanley, we would spend millions of dollars a year just trying to identify this asset versus that asset, and the correlation difference would be like 1 or 2% basically. Here you have just an ocean of alpha, like everywhere. There's just donors all over the place, whether it's information asymmetries, whether it's new assets that are completely innovating and popping up. It's like venture capital is liquid. It's like all of the opportunities are right here, but with that comes a heck of a lot of risk. And so you have to not rely on the regulator to save your bacon and be your nanny in this case. You just need to know, like, you're venturing into an asset class that has a lot of risk, and that's okay. Just size it appropriately. Don't invest your entire book into that asset class, and be there and let it grow and let it cook and let it bake and dollar cost average and do all the things that you were taught when you were young about investing, because there's so much opportunity here if you just take advantage of it, and it's right there, and it's not too late. That's for sure.
Yeah, both these guys spot on. Going back to what you were talking about with, attorneys kind of as the North Star, removing intermediaries, it goes a little deeper than that too, right? It's the title insurance that's really getting protected, right? So the ability to prove provenance, I think with AI coming on board, right? The ability to provide provenance of the data points that are being shared between AIs. Where did it come up with its data? How is it getting its data? The ability to tokenize the world around us. It's not just limited to Bitcoin, to Ethereum. There is a whole world of data. There is a whole world of tokenization that is at our fingertips. And I think if you're focused on the right places to look, it's going to be the places that are focused on removing intermediaries, because this next iteration of the web, the ownership economy, it's not just people owning stuff, it's systems owning stuff, it's data models owning stuff. It's really an ownership economy where systems can talk directly to systems and transact. I think Coinbase just did something really cool where they got two AIs to transact, right? These are going to be the mechanisms, and it'll go even further than that, where the AIs are asking the AIs, where are you proving provenance of data? Oh, I'm answering you from New York Times, and I got this answer from New York Times, this answer from here, this answer from there. And I'll pay you for that data. I trust your conclusion because of where you got it from. Or no, I don't trust the New York Times. I'm not going to pay you for your data. So the whole world around us, I believe, is going to be tokenized under under the covers, and focusing on the reduction of intermediaries is the sweet spot of this new world.
Wonderful. Thanks, everybody. Thanks to the panelists. And